Good afternoon, everyone. This is Joanne Stevens, and this is our Thursday call-in show for mobile home park owners and mobile home industry participants. So welcome, everyone. Just as we have a special guest today, Pierce Redmond from the Security Mortgage Group in Rochester, New York. Security Mortgage Group is a national lender of for mobile home parks, both for new acquisitions and refinancing, along with other. They do other commercial real estate as well. So we're going to hear some interesting information today and industry trends on lending from Pierce. So I'll introduce him in a moment. But before I do, I would like to remind everybody that next week, May 2nd, 3rd, and 4th, is the Las Vegas Congress and Expo that is sponsored by the Manufactured Housing Institute, the National Trade Association. That will, you can still register for it. You can go online to Las Vegas Congress and Expo.com, or you can go to my website, joannemstevens.com, and there is a link to being able to register and see the schedule and all the events. They have some tremendous educational sessions, which are always very valuable. I always learn a ton at this event, and it's a lot of fun to network and get fresh ideas from the other park owners and other industry experts at the Las Vegas Congress. It's being held at Caesars in Las Vegas, so it's still not too late to attend, and you can also register at the door if you just want to show up. I want to remind people also that to mark on their calendar December 11th and 12th in Cedar Rapids, we're going to have an owners symposium for mobile home parks, and we'll have experts speaking on trends, prices for mobile home parks that are being paid, financing for new acquisitions or refinancing your park, capital gains tax, what that is all about, inheritance laws, and we'll also have a workshop on putting a value on your park, a current market value. So if you bring some numbers, you'll have a confidential meeting with me, and you'll leave with the current market value of your park or community. So December 11th and 12th at the DoubleTree here in Cedar Rapids, and there'll be more information on the website and in the newsletter. If you want to, we're posting all of the newsletters online. If you need to have the newsletter emailed or faxed to you, we'll be glad to do that. Just let me know, and my number is 319-378-6786, or you can also contact Krista Null, and her number is 319-378-6818, and she'll be glad to assist you with that as well. So I want to get to our guest today, and that is Pierce Redmond. Pierce, are you with us?
Yes, I'm here. Thanks.
Okay, good. And Pierce, I want to mention a few things about Pierce. I think I've known Pierce Redmond for probably going on almost 10 years, and he was started there shortly after college, and was new to the mobile home park business, but he has always been very thorough, very professional, really knows his stuff when it comes to financing an acquisition or refinancing a park, and he's really speedy. If you give him the information, you're going to get a callback or response pretty quickly. So he's really come a long way in a relatively short period of time. His company that he's affiliated with, Security Mortgage Group, has been around for a long time, and it's a family business. Uh, I hope Pierce will tell us a little bit more about the history, but they have been honored, a number of times by the Manufactured Housing Industry Institute for being the top financial lending group or company in the mobile home business. So, Pierce, I wanted to have you tell us to start with a little bit about what you're seeing with activity. Are many park owners, are they refinancing their parks? And if so, are they happy with the rates they're getting these days?
Sure. So, generally speaking, again, we're Security Mortgage Group. Jerry and Anthony DeMarco are the owners are the managing directors of the company here. And I've been with them for about 13 years. And they're a family, like you said, a family business that started up about 1990, give or take, and have been concentrating on the mobile home parks since the mid to late 90s, really, as kind of a concentration of an asset class that is a lot of times misunderstood and a lot of times underserviced. So it's been a nice niche property type for us, and have found that there's a lot of need and willingness there from our lenders to finance this type of property. So in terms of the availability of loans or clients in general, their perspective of financing, we're coming up on, believe it or not, almost the 10-year time period of the financial crisis that we went through
Right.
on the residential side. So that is going to have some level of impact on rates and just loans in general. But for the most part, we've seen a pretty solid flow of transactions both on the acquisition side and the refinance side, given kind of a combination of things. One, where interest rates are currently being very attractive in terms of long-term fixed rate debt being at basically historic lows, and that combination with the availability of lenders to go up to 75, 76% loan to value and provide a few years of interest only in some cases, and again, a long-term fixed rate and a long amortization have really created kind of an ideal, currently at least, an ideal lending market for both acquisitions as well as refinances.
And what kind of can you tell us kind of a range of interest rates that you're seeing people pay?
Sure. So generally speaking, manufactured housing communities differ from other property types, whether it's retail or apartments, to the extent that each park is really looked at uniquely to itself, maybe more so than some of the broad-based terms that can be offered for an apartment, for an example. So depending on what loan size you're looking for, which can be a big determinant in what rates are available, there's kind of two general categories that rates might fall into here. So when you're looking to borrow north of roughly 1.5 million, we can do 10-year term, 30-year amortization, non-recourse based loans, whether that's in what they call the CMBS or conduit market, which are securitized loans in the Wall Street sector,
Sure.
or Fannie Mae or Freddie Mac based loans as well. When you get north of 9-10 million, you could access life insurance companies as well. But generally speaking, most parks kind of fall into this either Fannie Mae, Freddie Mac, or CMBS general area. Their rates on a 10-year long-term fixed rate deal are going to range from the lower side being, let's say high fours, low fours, to on the higher side being around 5% fixed for the full 10. So again, it's going to things like loan to value. If you're refinancing and only want to borrow 55% loan to value, you can usually achieve lower rates because it's less risky to the lender. And then on the flip side, if you're looking to borrow less than 1.5 million, give or take, we can our jumping off point is 500,000 as a minimum loan amount.
Okay. Okay.
Yeah. So from 500,000 to $1.3 million, $1.4 million, we typically are seeing recourse loans instead of non-recourse, and the longest our lenders are typically going at that price point is typically a five-year term, maybe a 7-year term, and a 25-year amortization.
Yeah, that's
something that might be, let's say 5%, for example.
And Pierce, if you wouldn't mind, talk a little bit about recourse versus non-recourse.
Sure. So, I know that's a kind of term or phrase that gets thrown around a lot, and just the knowledge of the availability of it based on what you're trying to borrow. So again, the longer term deals north of $1.5 million can offer non-recourse, and basically what that means is there's no personal guarantee to the guarantor. So if you do the loan, let's say you do a $2 million loan, everything's going great at the property, and then in year 3, 5 plants shut down in the town, half your tenants move out, and now you're kind of underwater on your mortgage payments, and you can't keep up, and you have to kind of go into a default on the loan. The lender can only come after the property. So it's a nice safety net, kind of in a doomsday scenario where, again, something bad goes at the property, maybe out of your control. You're just going to flip the keys to the lender and say, I'm defaulting on the loan, here's the property. So they can't then say, we're going to come repossess your car and, put a lien on your house and things like that. Again, the recourse side of it, and some people, some borrowers are totally fine with recourse and say it doesn't, I'm confident in my property, or I don't have any issues with a recourse-based loan. So those are kind of what the main differences are for some of the smaller loan products. They are in fact typically recourse across the board.
And Pierce, you mentioned the financial crisis that started in 2008 and kind of was pretty strong through 2010, and I think it's felt like in 2011 we finally started to come out of it a little bit and have been slowly coming back. But what I wanted to ask you is about the so-called recession-proofness of mobile home parks. That's something, I'm sure you've heard that. I've heard, different people say that over the years. So my question is, during the financial crisis when people were giving their homes back to the banks or their commercial real estate or their land, how do you think mobile home parks stacked up? Were they really recession-proof?
Yeah, I mean, from my personal knowledge, I don't have any hard data in front of me in terms of default rates among mobile home parks as they compare to commercial shopping centers or apartment complexes. But generally speaking, leading up until when the market crashed, mobile home parks were still not as aggressively lent on as your other commercial property types. So before the crash, shopping centers were lending, 90% loan to value, 6 years interest only, basing some of the income off of future rents. It was getting extremely aggressive and somewhat, irresponsible to a certain extent. Mobile home parks never really got to that level of aggressive lending. They were, still somewhat aggressive, 80% loan to value, a couple years interest only, things like that. So when the market crashed, I would, based on my knowledge, most of the community deals had not as aggressive terms put on them. Therefore, the default rate was a little lower. And just generally speaking, when you have a community of a couple hundred tenants or 60, 70, 80 tenants, it takes a lot of move-outs in kind of a short period of time in order to make a property default on its loan. So when you
Mhm.
look at a shopping center deal, two of your bigger tenants move out, you could be in a tough spot. In a
For
park,
sure.
you see a little more of a kind of level uh, level movement there in occupancy and everything. So that's generally what I've seen.
Right, right. And I'm sure you would agree that there probably were some lenders that were, as far as mobile home parks, that were doing some pretty aggressive lending. Maybe not your company, but that were in the 90% loan to value, and we're doing some, um, um, loans based on the perform and not on the actual income, but doing the loan based on a rent increase or more sites occupied or what have you. But even those, the ones with the aggressive lending, um, unless it was a real troubled property with, you know, um, a rural location or something, even those didn't really have the problems that um, other real estate assets had, like the shopping centers, the office buildings, uh,
Yeah,
and apartments and so on.
yeah, I would agree, and you can kind of get a sense of it as you look at a loan that's coming due off of a 10-year term, for example.
Mhm.
So when we see some of these loans coming due, if it was extremely over financed or aggressively financed 10 years ago and didn't perform well, you'd be in a position where 10 years down the road, you would struggle to even pay off the existing debt.
Mhm.
And we
Right.
haven't really seen much of that. I mean, there's been some transactions where, we're not offering huge cash outs after 10 years, but we're still able to get a new loan placed on the property. So
Mhm.
I think you're right. Generally speaking, even removing whether it was aggressively financed or not, the stability of the mobile home parks compared to some of the other asset classes does kind of show in terms of the loans coming due.
Mhm. Mhm. And Pierce, a lot of our listeners are mobile home park owners that maybe own one park or maybe two or three parks, and uh, some of their financing is with a local bank where they've had a long-term relationship with that local bank, or some of them have their mortgages are paid off. They don't have any debt on the properties. Are you seeing some park owners who don't necessarily own 30 mobile home parks? Are you seeing any of them come in and refinance their parks?
Sure. So absolutely, it's a question of not only what your short and long term strategies are for your park, but as I mentioned, with rates being in a position where they are as historically low and attractive, what happens is it allows you to kind of lock in something for a decade, not worry about any interest rate flexibility in the market, and just kind of let your refocus your attention to the operations of your property. So yeah, we've done a lot of work with people that own one park or people that own two or three parks and are looking to maybe refinance with a rate and term that they didn't even know was out there because they've only done loans with their local bank and they're not even aware that a 10-year non-recourse product is something their property could qualify for. And to go
Mhm.
along with that, Fannie Mae kind of had over the last few years has become more and more willing to do parks that are not necessarily what you would call, a 4.5 or 5-star property. They've done
Mhm.
a lot of deals for us in the last 2 or 3 years that maybe 6 or 7 years ago would not qualify for their program. So they've become more tolerable of different parks in the market, which are just really nice parks. They just might not be 5-star with a clubhouse and a pool, but that doesn't mean that they're not a 3.5 or 4-star well occupied deal. So that's also helped a lot of our clients as well, being able to tap into those really attractive rates.
Right, and you've done a lot of, I know you're based in Rochester, New York, but one of the things I wanted to ask you about, or have you explain to our listeners, is that you are a national lender. Is that right?
That's correct. So we're technically a broker. So and we do finance properties nationwide. And the advantage there is, as a broker, our fee is paid at closing. That's how we earn our kind of wage for the deal. So, we don't get paid until your loan actually closes. But secondly, we have access to numerous lending institutions that would be a potential fit for each deal. So you're not limited to just, for example, one product type that we offer as a quote unquote lender. We can tap into numerous options for you, whether it's a short-term deal, long-term deal, whatever is the potential best fit. We probably have a product or an option for you.
And yes, I want to make that clear to our listeners that it doesn't matter what state you're in, you can still help somebody who wants to finance a park they're buying or refinance an existing park. And with some of the smaller, the people who own 1 or 2 or 3 parks that are refinancing, do you have a sense, or what are you hearing as far as the reasons why people are refinancing? What are they doing with their the money from the refinance?
So it's any number of things. I mean, clearly, if you have a loan coming due, you're going to want to refinance to avoid any issue with your existing lender. But a lot of clients are, again, able to obtain a long-term fixed rate and a 30-year amortization. They might be able to pull out some equity that they have in their park and use that equity for any number of things, whether it's to buy another park, whether it's to repave the roads, buy 10 homes for your existing park, and increase your occupancy, whatever the case may be. But with the 30-year amortization, what that does is it allows you to quite possibly keep your monthly payment very close to what it is currently.
Mm-hmm.
So your cash flow on a month-to-month basis does not drastically change. Yet you're able to tap into that equity in your park and use it for any number of things that could increase kind of your personal cash flow, even more so than just paying down debt.
Well, that's I think that's something that will be very helpful to some of our park owners to hear about, because buying homes. So you're saying they can refinance the park and then buy homes and then either sell those homes or rent those homes, and the payments will be very reasonable. They'll have more income from filling more sites. And with the 30-year amortization, the payments will be relatively, that would be, for most park owners, that would be pretty easy to still make a profit after you pay debt. Is that what you're saying?
Yeah, absolutely. And when you think of it from a valuation standpoint, in terms of the actual value of your park, for every tenant you add, you're obviously obtaining that monthly lot rent, which is great for your cash flow. But for every tenant you add, you could be increasing the value, depending on the lot rent, anywhere from $15,000 to $30,000 the value of your park. I mean, if you're able to refinance, pull out some equity, add 5, 6, 10 tenants to your property by having homes available or making improvements and making your park more marketable, you could in reality be adding $200,000 to $300,000 worth of value to your park, because an occupied lot is worth substantially more when you look at the valuation from a income or cash flow perspective.
Yes, that's a really good point, Pierce, and you're absolutely right about that. And an increase of $15,000 to $30,000 for a park site that is filled and producing rent from a tenant, it could very well be more than $30,000. I'm sure you're seeing that too, that the prices are rising. Part of it because there's just more investors that are very enthusiastic about buying parks, and part of it is the low rates that help help make it very a good investment.
Yes.
And so it really is to the seller's benefit to, or to the, even if you're not a seller, it's the owner's benefit to improve your cash flow by filling those vacant sites.
Yes, I couldn't agree more. Yeah.
And I know, there's been, it seems the park-owned, let's talk about park-owned homes for a moment, because it seems like several years ago, maybe 2012 or something, when the financing was starting to come back in a more robust way. I mean, financing was kind of tight during the financial crisis for anybody to buy any kind of real estate. But it seems like some lenders seemed more tolerant of parks that had park-owned homes. And what are you seeing, or what can you tell us about how a lender views the park-owned homes?
So every lender has really a different threshold for what they will allow or consider when looking at the park-owned home. So generally speaking, as a general rule, outside of just a very small handful of lenders, they do not count the value or the income from the homes in their loan. So, if you're buying a $2 million park and it has 10 homes, they will not finance the income from those homes or their value. But a lot of times, if the homes are included in the purchase, we can assign, a relatively nominal value to those homes as it reflects in the purchase price. So we've done that before. But you want to make sure that whatever you're paying for the park itself is a reflection of just the income from the lots at the park. So if someone's paying, $800 a month for a park rental, and the average lot rent at the park is $250, we can count the $250 of that $800 towards lot rent when you're kind of running your numbers, but we just can't count that extra $550 that you'd be receiving towards.
Okay.
So that's something to keep in mind. But in terms of an overall threshold or percentage, there's nothing written in stone. We've done deals with 50% park-owned homes, 45, and to go along with that, there's so many different classifications now. There's rent-to-own, pure rental, lease.
Sure.
Some people hold paper in terms of
right.
homes for there's a whole kind of different way to look at it. But overall, again, it's a reflection, as I said earlier, of each deal being looked at uniquely. If you have a park that has 40% park-owned homes, but it's 100% occupied, there's been a great track record there, and we're willing to kind of carve out those park-owned homes on the valuation side, we could probably do the deal. If it's 40% park-owned homes, but the park's only 65% occupied, and income's been sliding a little bit over the last couple of years, it could be problematic. So it goes to the overall kind of all aspects of the deal being important. But there is no technical threshold of what we can or can't consider on the park.
Okay. Well, that's good to know, because I think that stops a lot of park owners from pursuing refinancing, because they just are kind of operating under the old assumption that if there's a certain, too high a number of park-owned homes or too high a percentage, that it's a non-starter for the banks, and you're saying it is not.
Correct.
So, and also you said something interesting about you assign a value of some sort, probably having to do with age or that type of thing. And rather than doing, if it is a rental home, for example, rather than doing a net operating income on the rent for just the home, taking out the lot rent, and then just assuming that there are expenses with having a rental home, and then coming up with the net income on the rental, you're circumventing that and just assigning a price to the home.
That's correct.
Correct. And so, let's talk about interest rates for a moment, because a few minutes ago you said that when you were talking about these CMBS loans and depending on the size of the property and the loan, if the interest rate might be as low as the low 4% interest, like under 5%. I'm sorry, 4% interest, or even slightly less, or slightly above that. What do you think, Park, we should expect to see on interest rates? It seems like every time you hear the news or pick up a financial paper, there's been a lot in the news about interest rates going up, but it doesn't. When talking from what you said, it doesn't seem like they are.
Well, I mean, there's movement every day in the treasuries, and it's going to be a reflection of the stock market and a lot of other factors. Today, for example, the 10-year treasury, which is the index that a lot of our lenders use to price their deals, is at about 2.3%. So it gives you an idea that historically that is an extremely low 10-year treasury rate. And the corresponding rates, they typically apply a spread. Our lenders do. That's how they, price their deals. They apply a spread over the 10-year treasury. So that's where we come up with the kind of all-in rate, somewhere between low fours and mid fours, depending on the lender and leverage and everything like that. And since the rates are priced off the 10-year treasury, and based on where they are in the historic 10-year treasury rates, the prime rate and everything like that, only they could absolutely stay at this level, but to think that they would go much lower than this level is unlikely. It's only makes sense for them to eventually, at some point in time, trend back upward a little bit to a level. Again, there's no predicting how fast or how high or what the case may be, but just generally speaking, being at such historic lows, it's hard to believe that they'll stay here forever.
Although they have been there for a while now. And Pierce, I meant to at the beginning to ask you for your contact information. So if one of our listeners wants to, what's the best way to reach you? And what is your website?
Sure. So again, the managing partners here are Jerry and Anthony DeMarco. And my information is, my email for sending deals over is Pierce, P-I-E-R-C-E, at securitymortgagegroup.net, and then our website is securitymortgagegroup.net as well. So that's the easiest way to contact us. Our phone number is 585-423-0230, and more often than not, either myself, Jerry, or Anthony picks up. So that's the easiest way to reach us, to run through any type of deal scenario that you might be looking at.
Okay. And one of the questions that I get asked a lot from park owners, especially park owners that are a little bit older, is what is the future of the mobile home park business? We have a lot of older mobile home parks in the country, and we haven't really built very many parks in the United States in the last 15 years or so, maybe a little bit longer than that. Do you have an opinion about that, or what are your thoughts?
I guess there's two ways to look at it. If you look at pure, and again, I don't have the numbers in front of me, but if you look at pure manufactured home production, I know that over the last 25 years, the number of new manufactured homes produced in a given year has decreased. However, I also think that there was probably some overdevelopment in terms of the actual parks themselves. So I don't think that that's an indication to say, just because production of new mobile homes is down, that the industry is struggling or running into potential problems. Because I think the fact that affordable housing is going to stay and become even probably more prevalent an option for a large part of the country, I think that bodes well for mobile home parks continuing to remain a strong option for, again, affordable housing and the parks kind of maintaining themselves. And I know that there's been, and you could probably comment on this as well, with the compression of cap rates on on acquisitions when, some of the bigger kind of publicly traded companies are starting to dip their toe into mobile home parks as well. It can kind of compresses the cap rates and makes, everybody's park more valuable really when,
Hmm.
people are willing to pay in some areas of the country 6.5, 7 caps for acquisitions of parks. So
Yes, it definitely does, and the demand is definitely strong. So we only have a few minutes left, Pierce, and just in case I didn't mention this to you, and our time is up. It's up, and the program that we use, it's going to toss both of us off. So we're going to talk for a couple more minutes, and then we're going to
okay.
um, tell end the show. Um, but I wanted to, before we do that, I wanted to ask you if a park owner wants to refinance, what kind of information do they need, do you need from them in order to help them understand how much they could refinance their
Sure.
park for how the process works?
Sure. So the easiest thing for what we need, we keep it very simple. We need a couple years of income and expense statements on the park. If you have a trailing 12 months, that's extremely helpful. We need a current rent roll, some photos of your park. We have a 2 or 3 page questionnaire which asks questions about the utilities, the address, the number of park-owned homes, the last rent increase, things like that. That kind of help
Okay.
guide us as well. And then, possibly some just info, bio or resume on the guarantor, so we know kind of what our lenders are looking at in terms of the strength of the actual guarantor himself or herself.
Okay. Okay. Well, that sounds really not too terrible. Something that people can get together without taking a tremendous amount of time. And so we just have a couple of minutes left, and I wanted to remind people that you will be in Las Vegas, and you'll have a booth there. Is that right, Pierce?
I'm not sure if we have a booth, but all three of us will be out there walking around the receptions and
Mm-hmm.
the lobby and everything. So we'll be there.
Yeah, and so look for a young guy because Pierce is one of the youngest guys in the finance business and in the park business too, for that matter. So just look for a young guy, and he'll be able to talk to you quite knowledgeably about your park and the outlook for refinancing it. So I want to thank Pierce for being our guest today. You did a great job, and I'll see you in Las Vegas, Pierce.
Sounds great. Thank you so much for having me on. I appreciate it.
You bet. Take care.
All right. Thanks, Joanne. Bye.
Okay. Bye, everybody.